Have you ever wondered why bond prices and interest rates move in opposite direction? It's a topic that often confuses people new to finance, but once you break it down, it makes a lot of sense. In today's video, I'll explain why bond prices and interest rates have an inverse relationship and how this dynamic affects both investors and the overall market. Let's dive in. To understand the relationship, let's first get clear on the basics. A bond is essentially a loan you give to a company or government, and in return, they pay you interest over a specified time period. The face value or principal of the bond is the amount you initially invest, and the interest rate, also known as the coupon rate, determines how much you'll earn each year. Now, what happens when interest rates change in the broader market? This is where things get interesting. Let's say you buy a bond for $5,000 with the 7% interest rate. You're earning $350 annually in interest. Sounds good, right? But what if the market interest rate jumps to 10%? New bonds issued now offer a much higher interest rate, $500 annually for the same $5,000 investment. So why would anyone want to buy your bond that pays only $350 when they could earn $500 with the new one? Exactly, they wouldn't. Unless you lower your bond's price to make it more attractive. The price of your bond would need to drop to compensate for the lower interest rate compared to the new bonds. This is why bond prices fall when interest rates rise. Now let's flip the situation. Let's say you have the same bond for $5,000 with a 7% interest rate. Now, imagine the market interest rate falls to 5%. New bonds are only paying $250 a year on a $5,000 investment. Suddenly, your bond that pays $350 annually looks a lot more attractive. More investors will want your bond, so you can now raise the price when selling it. In this case, because your bond is yielding more than new bonds, its price will increase. This is why bond prices rise when interest rate falls. So, what is really driving this inverse relationship? It all comes down to supply and demand. When interest rates rise, new bonds become more appealing because they offer higher returns, making older, lower yielding bonds less valuable. The demand for those older bonds decreases, causing their price to drop. On the other hand, when interest rates fall, those older, higher interest rate bonds become more attractive, leading to an increase in demand and a higher price. This relationship is critical for bond investors to understand because the value of their bonds can fluctuate depending on what's happening in the market. Understanding the inverse relationship between bond prices and interest rates is key for making informed investment decisions. Whether you're a seasoned investor or just starting out, knowing how changes in interest rates affects your bond can help you manage risk and maximize returns. Thanks for watching. If you found this explanation helpful, don't forget to like the video and subscribe for more content on finance and the financial world.